We now proceed with the next session on the topic Consolidation and Regulation in Banking. And for this session, I invite our moderator, Mr. Abizer Diwanji, founder NeoStrat Advisors LLP, and our panelist for this session, Mr. Prashant Kumar, MD and CEO, Yes Bank, Mr. Neeraj Makin, Senior Executive Vice President and Group Head, Strategy, Analytics and Venture Capital, Emirates NBD, and Mr. Anshul Agarwal, MD and Head, Financial Institution Group, Avendus Capital, to kindly join us on the dais. Speakers, please kindly join us on the dais.
Okay, so clearly we will start. We just had an engaging session with the ex-regulator, Mr. Rajeshwar Rao, who basically spoke about the fact that there needs to be consolidation in the financial services sector. And he also spoke about the fact that regulation is pretty much aligned to enable that consolidation. This panel actually is supposed to talk about a deeper version of consolidation as well as regulation. And instead of the regulator, I have practitioners. So I guess we will get a slightly more clearer and a better picture of how things will move compared to what people would desire them to move. But just looking back, I'd just like to set context to what regulation is about and what consolidation has happened. Last year, the financial services sector has seen commitments. I'm saying commitments because the money hasn't come in as yet, but it's all committed and tied up, to the tune of $10 billion in the financial services sector. And we've seen deals from significant minority deals like SMBC, complete transaction deals like Mizohu, or majority deals like ENBD. We've also seen private equity deals like Blackstone and a 20% stake, Blackstone into Federal, and a 20% stake that we saw recently in Shriram. And of course IDFC. So we've seen a lot more money coming into the sector. That basically tells us that the sector is getting more and more capitalized. And the reason why the money comes in capitalized is because a good perception has been created that the sector now is clean for investments. And because it is clean for investments, people have cleaned up the balance sheets. They've shown sustained 2 to 3 years of good performance going forward. However, we sit on a retail bubble, and we will continue to sit on one. That will evolve over time, but we'll never see something like a 2016. That's the expectation. And hence, banks are now safe, or financial institutions are now safe to put in money. Now that so much capital has come in, 10 billion levered 5 times over is $50 billion. And $50 billion pretty much will end up doubling the size of every investing company which has now received the money. Now that basically goes to show that are we on the onset of creating another bubble thanks to the capital infusion? Something to address today. The other larger issue is, where does this trend show? The one trend that it clearly shows everybody is that there is significant consolidation happening in the banking sector. Now what is happening? Subscaled, medium-sized banks and NBFCs have fallen vulnerable to every crisis that has happened to the banking system. They were obviously badly hit by ILFS. Thereafter, they were badly hit by the recent MFI crisis. They have been hit by the SME crisis. So what happens really is that whether they have the exposure or don't have the exposure, they have taken a beating as a result of this, either in terms of supply of money, which is a deposit evaporation, or on the NBFC side for getting bank loans in to fund operations, or a general dip in the share price, making it unviable for them to raise capital. So the mid-sized financial institutions have seen a significant impact or vulnerability to events that happen, and events will continue to happen. So clearly, as Mr. Rajeshwar Rao also said in the last session, what we really need to focus on, how do we consolidate our entities and get into larger entities? What happens when capital flows into banks like SMBC and RBL and Shriram? Are they going to do much of the same thing, in which case we may end up creating bubbles? Are they going to do different things, which is maybe they will be enabling consolidators? And if they are going to be enabling consolidators, you will find that we will end up creating a large conglomerate of banks going forward. And our banks, I would include NBFCs in banks. Another interesting trend that has started is, Lata spoke about the fact in the last panel that there's a race for deposits. There's a NIM margin, and even Rajiv Anand said it in his panel. There is a pressure on NIM margins. NPLs can't be controlled because of cycles. All you can control is costs. Now, what you can also control maybe and to think about is the liability side. Now, what is happening on the liability side? Just some numbers. Total deposits in the banking system is 2,30,000 odd crores. The total amount that has moved to mutual funds over time has increased from 30 lakh crores to 80 lakh crores and is expected to reach 100 lakh crores in the next 2 to 3 years and 300 lakh crores in a phase after that, which is a mid-term. Now, 300 lakh crores, obviously deposits will also grow by that time. But at the end of the day, you will have a deposit and a mutual fund AUM more or less the same. Now, that basically says that there is a lot of pressure on the banking system to retain the liability. That's one point. Secondly, if we just analyze this liability, I think it's truly a liability because out of the growth, approximately 10% growth in deposit year on year for the banking system, savings have degrown. What has increased has term deposits. Term deposits as a percentage of total deposits today sits at 62%. And that I think thinks that 62% is only because, as Lata again mentioned, the tax arbitrage was taken away between long-term fixed income mutual funds and banks. If that was not taken away, maybe it would have been a further shift of term deposits into fixed income mutual funds. But see the change. Liabilities are getting costlier. They're effectively turning into bonds because if 62% is in term deposits, literally bonds. So at the end of the day, the cost of funds is under pressure. But what is going to happen? Look at people in the larger bankings that have evolved. While conglomerates are not allowed to do banking, they have evolved into financial sector conglomerates. A Kotak or an SBI or an ICICI Bank or an Axis just starting about. They have their own securities businesses. So now they're trying to capture the whole capital market play through either deposits or any other asset forms. And again, Mr. Rajeshwar Rao said, AIFs or private credit will move faster. Structured credit will move faster. PMS will move faster. Wealth management will move faster. And wealth management, we are seeing the kind of valuations wealth management is getting. At the end of the day, as and when the investor gets more and more yield seeking, there will be a shift from banking to capital markets. And people who establish conglomerates, that's the next level of consolidation that will happen. So once there is consolidation of size, which is banks and NBFCs moving, I actually see a time when the likes of Bajaj will actually be given a banking license. But there will be a consolidation where size will first consolidate and thereafter there will be a horizontal consolidation in terms of making sure all products are offered by a conglomerate financial institution. So this is the initial view, and I think we have started this practice with an initial flow that these gentlemen here have been part of a transaction. So I'll start with Mr. Prashant Kumar. Sir, Yes Bank has first of all been an excellent turnaround story, and we'd like to know more about that. Firstly, you got initial capital, I would say call it savior capital from the PSU banks, and which you've returned them a handsome amount back though, which is amazing. But then you got confidence capital from the private equity guys. And thereafter you've now got kind of permanent capital. And don't know what happens with the SMBC now setting up a wholly owned subsidiary, but we'll leave it with that. But what do you think has been the journey, what's driven that journey, and how has that actually happened?
No, I think absolutely. I still remember like March 2020, almost 6 years back, when I have to first declare the quarterly results for December 2019. Because December 2019 results were not declared when I joined after the moratorium was imposed. And that was a 18,000 crores of loss. So we started the journey like the first quarterly results of 18,000 crores of loss. And today, fortunately, in our latest quarterly results, it was a profit of almost 1,000 crores. So I think this journey of 6 years absolutely has seen, but this is the first of kind in India. This kind of experimentation was done And again, when we talk about the regulation, I think this was a courage when the regulator has decided to also give a try to this kind of model. Where not only like State Bank of India, but a group of private sector banks also came together and provided the initial surviving capital to the bank. But definitely, I think if we take it forward, not only the regulators continue to provide that kind of support, like I still remember when the initial capital came to the bank, the then Governor of Reserve Bank of India, Mr. Shaktikant Das, he also suggested that getting a funding line is also very critical. Otherwise, without a funding line, you would not be able to survive. It was very difficult for us to even understand whether the funding line and how much funding line. And I remember, like I was talking about, maybe we made some calculation, maybe something around 30,000 crores. He said, you take 50,000 crores. And the first time regulator is talking about giving a funding line to a bank to the extent of 50,000 crores, okay? With definitely a confidence that this money would come back. Because ultimately it's not easy that capital is one part, but the 50,000 crore would be given back to regulator, and that's again a very, very big, bold call, I would be saying, Reserve Bank of India has taken. But I think this experiment has succeeded, despite like immediately after March 2020, the COVID, when the entire, not only the entire country, the entire world was under a lockdown. So even during that time, I think we would be able to raise $2 billion of capital in, say, July 2020. So normally, like capital raise, you travel to different geographies, you convince your investor, everybody. We were just sitting in one room and we were able to raise that 2 billion capital. I think that was the journey, and we were able to refund that 50,000 crores within 6 months to Reserve Bank of India. That actually increases the confidence of everybody in the system. And I think rest is history, where like gross NPAs was something around 18%, and today we are sitting with a 1.5% gross NPA with a provision coverage of almost 83%. If we see the deposit growth, I think especially we were talking about the saving deposit, CASA deposit. Growth in CASA deposit is one of the best in the industry, what Yes Bank is doing today. So I think this experiment has absolutely proved successful. But again proves like if everybody comes together, everybody has a clarity like this is one initiative which we need to support, and we had a wonderful team in Yes Bank who has actually worked to make it successful.
But sir, when you got confidence capital, it basically was confidence in you. But how did that capital enable you to build confidence in the customer?
No, actually, like it's not about confidence in me. It's about the confidence in the franchise which has been created. So I think what we have done after like March 2020, we were not looking at a number. I tell you like the first day when the moratorium was lifted, the message to the branches was that if a depositor comes to a branch to withdraw money, please don't put any restriction, don't put any limit. If he says, I want to have 5 lakhs, please give it to them without any question. Okay? So I think we created that confidence in the mind of customers from day one, right from the first day, that this bank is having a full support from regulator, having a full support from a group of banks, and everybody is working towards the interest of the depositor. I think this message, this communication, and I still remember like every day, including me, I was just picking a phone and speaking to at least 20 customers every day. So when the CEO of the bank starts speaking to the customer, who may be a retail customer, corporate customer, clearly telling him, there is no need to worry, your money is safe. And that was demonstrated like you go to the branches, you want to withdraw your money, and absolutely no question asked and money is paid. So I think this is how the confidence in the customer has been built up. And returning 50,000 crore to RBI within 6 months. That actually shows like the customers started, and I think in the first year, we had a 60% growth in deposits. in 2020 end, 1 year, 60% growth in the deposit. So I am saying it's ultimately the confidence in the franchise by the depositors, and definitely on the back of SBI being the support, SBI being the bank. I think that was the most critical aspect.
Absolutely. And of course, it takes courage to clean up a balance sheet and move on and saying, I'm going to take the write-offs, which is amazing. Sorry, Neeraj, a very different level of consolidation now being proposed. Of course, Yes Bank was a consolidation supported by SBI, and thereafter, and other banks, of course, and thereafter now they've kind of got SBI out, RBI support is out, and they've managed to now get a strategic investor in. But another strategic transaction that is now happening, and another form of consolidation, is actually new money in a mid-sized bank, with the hope to convert it into a larger bank, which will get rid of the same vulnerabilities that we spoke about. So, first of all, Neeraj, first time such a large transaction has happened in Indian FDI, in banking, significant size. Why India for you? And why what you did?
Okay, so I think maybe before I come down to why India, there's, for me to give a context of who we are as Emirates NBD, right? So we are one of the largest banks in the Middle East. We present in 13 countries. And we've evolved from, like these were two banks, Emirates Bank and National Bank of Dubai, and the history of the bank goes back beyond 60 years. National Bank of Dubai was set up in 1962-63. And for the next 6 years, the bank's balance sheet, which I have the original balance sheet with me lying in my office, is in Indian rupees. So not many of you may not know out there, but UAE wasn't there in 1960s. UAE was only formed in 1971, 72. And at that point of time, it was the Reserve Bank of India which provided currency to what was used to be called crucial states. So let's put it this way, we've had a long-standing relationship with India, right from that perspective. But going forward, as the bank grew, and in 2007, when these two banks merged, Emirates Bank and National Bank of Dubai, I think the idea for the merger was to create a regional champion. Of course, we ran into some turbulent waters with the global financial crisis and Dubai's own financial crisis. But by 2011, we were out of it, and then we started building the franchise. When we started back in 2010 or something, only 3% of banks' revenues used to come outside UAE. We were 97% dependent on UAE. And with the financial crisis and Dubai financial crisis, we realized as an institution that, look, if we want to carry on and grow, we need to diversify. We cannot be a single trick pony. And that was one of the founding blocks for our international strategy. And since then, we've kind of moved forward. One of our first large forays was buying a bank in Egypt. We bought BNP Paribas back in 2012, 2013. Then we moved organically into India, grew organically in Saudi Arabia. And then in 2019, we bought Deniz Bank in Turkey, which was nearly a $3 billion transaction at that point of time. And around the same time, India was always very important. We were present in India as a rep office from the year 2000. I think I joined the bank in 2008, and one of the first projects I was assigned was, Neeraj, go and get a license in India. And I tried 2009, and I think so 2011-12 was the first time I started working with Abizer when we were still trying to get a license in India. And I think a lot of water has passed under the bridge, a lot of things have changed. We got a maiden banking license in 2017. And then around 2022, we made a decision that, look, if we need to be in India, this is the right time. We have to kind of take a bold step forward. And we started looking forward to see what can we do more in India. And we thought of two options. Obviously, a government divestment came up around the same time, but we also started looking very seriously at saying, okay, if we were to go and open a wholly owned subsidiary in India, how does that pan out? And within that context, we started looking at various opportunities in India, which I can probably say that, Prashant, that we did have a good look at you guys also in that process. So why India? Because we felt that India is one of the core markets. What we have defined as a strategy today is that we have 5 core markets: UAE, our home market, Turkey, Saudi, Egypt, and India. And that's about it. We don't want to be like a Stanchart, Citi, or HSBC, where we want to be a global bank. We want to be a regional bank, and India fits the bill. More than $100 billion of trade has happened between India and UAE in this financial year. More than 4 million Indians reside in UAE. Total population of UAE is between 10 to 11 million. So you're talking about anywhere between 35 to 40% of the population of UAE is Indians. There's a huge Indian diaspora, the trade links are strong. So there was, coming to India as a big financial institution was a complete no-brainer for us. I think the only question was, how are we going to do that? One thing which was also very clear for us that we didn't want to buy minority stakes. So we were always looking, and the reason it took us from, let's say, from 2012 to 2022 or 2023 to make up that decision was that we couldn't find anything which could give us a majority control stake. And of course, there was in the previous panel questions asked about the control and the voting right from for foreign banks. And those were some of the critical things which we had to take into account as we moved forward. And it wasn't easy for us to come down to terms with some of the things. But I think so, it has been a challenging journey, but for us, the ability to have access to a growing market like India was more important. And that's where we said, okay, fine, this is the right time, we should go in. And I think the other reason which, my boss talks about, and I think he picked it up because he used to be in Hong Kong in 1997 when financial crisis happened, and he's seen how the Chinese banks grew. And he came up to me and he said, Neeraj, can you go ahead and do me a research for me that what was the size of Chinese banks in the year 2000 or late 90s? What is the size of the Chinese bank now in early 2020s? And how the banks have grown and all and everything. And when we did the research and we came out, it was actually quite eye-opening, right? Because today, if I look at it, Yes Bank is about $50 billion, right, in asset size. Those days, some of the Chinese banks, the mid-sized Chinese banks, were around that 35, 40, $50 billion. Guess what's the size they are today? More than $500 billion, $700 billion, $800 billion. There are at least 5 banks which have assets of more than $1 trillion in China. And all that happened because China grew at a rate of about 8 to 9% over a 20-year period between 2000 and 2020. Now, juxtapose that with where India stands today, right? So India today is growing between 6 to 8%. And for us to reach that developed or Viksit Bharat, as Pradhan Mantri says, by 2047, we need to continue growing at that 7% rate. So if India has to grow at 7% rate, the banking has to grow at 2.5 times of that growth. That means you need the banking sector to continue growing at 15 to 18% per annum, which is what the banking sector is doing today. Which is then when you want to see that, okay, where the banks will be. So one of the other things, why India and why now, was because this was the right time. Because today if somebody tells me, Neeraj, would you want to go to China and can you go to China? No, we can't. Bank our size cannot even dream of buying a bank in China because they're too big for us. But in India, we could today. And one of the things which we talk about is that, whether I will be there in Emirates and BD or my bosses will be there in Emirates and BD in 10, 20 years, but they'll be thanking us for if we are able to conclude this deal because this could be a great.
Neeraj, how did you navigate the regulation? Though, of course, Mr. Rajeshwar Rao said it's very simple to do it. But, there was an unwritten rule that strategics will not get more than a 10% stake in banks. Unwritten rule. There is no regulation, by the way. And hence, but to actually go and have the ability to tell the RBI that we want a majority. So how does that mindset pan out and what are the regulatory interactions?
I think it was, constant dialogue with the regulator, with the government, and I would also kind of give a bit of a credit to the relationship which the two countries share. I think the the relationship between India and UAE has been kind of going from strength to strength. I think day before yesterday, you had a very unscheduled stop of 3 hours by the UAE president to meet the Prime Minister. But I think there were various building blocks, right? I think the country-to-country relationship. I think the understanding within the government also was changing that for the Indian economy to continue growing, the banks need to be bigger. We've talked about consolidation and banks being bigger, and you need capital. Unlike other countries, India cannot, or I would say not unlike other countries, unlike more different style of India as a democracy, their government is answerable to the parliament and all anything. They cannot continue to put on unending amount of capital in banks, right? So they had to think, so where is the capital going to come from? The capital can be created domestically, but then there's this other question that conglomerates are not allowed to be in banks. So that's one source of capital, but that source is blocked. Foreign capital was also blocked. So I think the government has probably, along with RBI, through various discussions, discussing with us, came down to a conclusion that allowing foreign capital coming from institutions who are running successful banking businesses around the world is probably a first step to take as the sector deregulates and all and everything. And I think so, it is that constant dialogue, putting the right set of arguments. I have to say that there were numerous rounds to Delhi and to Mumbai over the last 3 years to come down to this conclusion.
But you cleared the path now. I think most other people can now quote you as a precedent and go ahead with doing what they want to do. That's amazing, Neeraj. Thank you. I'll move to Anshul. A very different transaction in the financial sector. Another form of consolidation actually. While we saw the banks, one of them stressed, got capital in pieces and has proven itself, one where a chunk of capital is coming in straight, and the third one is a complete buyout, where a significant investor has sold a stake, a private equity, and a strategic has bought the case. And clearly this is a case where we're setting up a truly global investment bank here. And I think this is the first time a domestic institution is morphing into a domestic institutional bank. So one is, Anshul, you're a banker yourself, so you know all the synergies. But where do you think the role of global institutional banks is now? And how do you think it's going to make a difference to your current franchise?
No, absolutely. Thanks, Abizer. And just for the benefit of audience, it is a banking conference, but frankly, for an investment bank, we are not a play only for FS sector. We are essentially, it's a play on the broader India economy. So just to give you a context about Mizuho, Mizuho is a global banking institution based out of Japan, but their core focus beyond Japan is actually into investment banking. And based on that, they essentially acquired a controlling, or say 100% stake in a company called Greenhill in US in 2023. And the desire to actually was to promote a cross-border M&A advisory. As part of that, now the commitment is, or the target is to become a leading investment bank out of Asia in the next 5 years. And if you want to be a leading investment bank in Asia, then obviously which better place than better than India? You have to be in India. Without India, you can't. So Abizer, in fact, asked a question to Neeraj that why India? In fact, the question is why not India? Because honestly speaking, we all know about the numbers. And look, I am an investment banker and I love numbers. Investment bankers, two things about investment bankers so that you know, they are eternal optimists and they are very fond of numbers. These are the two key criteria for being an investment banker. So India has a GDP of roughly about $4 trillion. So everybody knows it, right? And then the market cap is roughly about $5 trillion. So, but I think not many people will know the total world GDP is roughly in the tune of about $120 trillion. So India is about 3.5% of the world. So, but when I talked about a market cap of $5 trillion, out of $5 trillion, the FII AUM will be about close to $1 trillion. And the global FII AUM will be about $125 trillion. Like you would have heard of names of Blackstone and BlackRock and Vanguard. The total AUM of the world is about $125 trillion. So India is less than 1%. So what we are saying is that even though India contribute to close to 4% of the world GDP, in terms of the asset ownership from foreign institutional investors, it is less than 1%. So what you are seeing as of now is that so much capital which is coming into India is not by chance. It has to happen. Because essentially the world has to balance that wherever the GDP is getting generated, the financial assets needs to move there. And that is why another data point that in the last 5 years, India has got about $250 billion of GDP, of the FDI flow, and about $1.4 trillion of FII flow into India. So you have heard all the newspaper stories that FIIs are pulling money out of India. Frankly, it is a very healthy sign of market that when somebody invests in the market, make money and get the money out of the country. You cannot keep the door slammed shut. When you have made the money, you can't take the money out. That's not a healthy sign. So as an investment bank, we thrive on capital flows. Why I'm making these points is that unless there is a healthy flow of capital, that capital has to come in, capital needs to make return, and it has to go out of the country, then only a country can survive and will attract more capital. Otherwise, it will die its natural death, right? So as an investment bank, just to explain you guys in the model in a very simple layman terms, as I will explain my son, that imagine that we are a pipe. On one side of the pipe are the entrepreneurs and the companies who are creating value. On the other side are the capital providers. Our job is to marry them both. Now, as the companies and the countries will keep on evolving, we need to be agile and we need to essentially do better. We have to be relevant in the market. So that is why we need to continuously innovate. We as Avendus started with the private capital markets. So we started with the private capital, which you have heard of the terms called private equity and the venture capital. We then moved into HNI, which is where we got into the wealth management. So HNI capital is a big capital today that a lot of HNIs actually put in money as an unlisted shares in the company, which contribute to the growth of the companies, right? So we got into wealth management, we got into HNI capital. Over a period of time, the market matured further enough, we got into structured products because all these stocks of private credit and the structured credit solutions, we got into that as well, right? And then we all know about the IPO market. IPO markets are booming. In the last couple of years, India has raised about $25 billion of capital per year from IPO markets. So we have gone into public markets as well. So as the capital is evolving, the companies are also evolving. So just to answer the question which Abizer asked is, this transaction actually is a play on, which I coined the word 2 terms is, it's a bold and ambitious India. What we are seeing actually across multiple sectors are that India is getting bold and ambitious. I think you guys would have seen the news story of yesterday when essentially Sun is talking a $10 billion acquisition of Organon. This is essentially an example of getting bold. Tata has acquired Iveco for $4.3 billion. Or in Hyundai, Indian market has actually given them a liquidity of $3.3 billion. So India is a market which is getting ambitious. Companies are getting ambitious. We are expanding our footprints beyond the country. Plus our capital markets are so deep that we are telling the foreign corporates is that you come to India, list are here and take the money out. So essentially there are multiple large MNCs which are not listed in India, but like a Hyundai, like an LG, like an Okla, they all got listed last year. So they have actually monetizing their assets in India, which is actually giving them a flip in the global markets, right? So what this partnership actually offers between Avendus and Mizuho, right? Now, Mizuho is a global corporate. They have their global clientele. Everybody wants a sliver of India. What this partnership actually enables Mizuho is that they can claim that they have an on-the-ground presence in the country, which can essentially help their cross-border clients to come and deploy capital in the country. That is one. From our perspective, we are very well entrenched in the India, but now we can go back to Tata's or we can go to RBL. That, okay, why don't we actually help you in taking some assets out in US or in Europe? US, EMEA, which is the Europe, Middle East and Africa, but typically it's a Europe and Middle East and Japan. These are the 3 key corridors, US, EMEA and Japan, which are going to play a disproportionate role in capital flow into the country. So what this essentially partnership does is, in a big way, we can offer a cross-border M&A advisory. Not being a domestic bank doesn't help. So that's the reason why the strategic partnership with the foreign partner. And based on their global balance sheet, we can then essentially offer more financing and the forex solutions to these corporates. As I said earlier, that companies are now becoming far more savvy. They will desire more complex products, and we need to also continuously innovate ourselves to actually offer those kind of services. And last but not the least, we all are actually going to create tremendous amount of wealth in our lifetime in the next 10 years. it is a play on the wealth as well. It is not only an investment banking M&A advisory story. The wealth management is going to play a big role. There are about, last count is about 100,000 ultra HNIs in the country. And as you know that, look, there is an LRS of about 250K. Even if I assume, suppose $100,000 is actually taken out of the country by each HNI for deployment, we are talking of about $10 billion of investable surplus, which will go outside India for an offshore opportunity. So by having a part of a global bank, we can essentially offer them a holistic services. We can manage their wealth in India, plus we can manage their wealth offshore as well. We can offer them offshore products. And similarly, because India is an attractive investment destination, there is a lot of global pool of capital which is dying to come into India. So again, Mizuho can claim credit that, look, we understand India market and we can curate some specific strategies to get that money channeled into India. So to summarize, the benefit of being an India global partnership is to essentially play a lot of cross-border M&A theme and plus on the wealth management as well. But ultimately, it's a play on India. We are fortunate that we are living in an era where India is doing well. And essentially, as India will continue to evolve well, we believe that M&A market and the wealth management advisory market will continue to do well. So essentially, bold and ambitious India, that's the way to go.
Amazing, amazing, Anshul. Very frankly, if you look at the trend across all the three of these deals, it's basically, yes, putting in more capital to make the domestic entity more resilient, but also opening up that entity to do much more on the cross-border side. As just explained, for example, the big issue here is that you open up global markets to Indian investors or to Indian corporates tomorrow from the M&A side. So I think a lot opens up because of this classification. But so Anshul, to you, I'll start the other way around now. Very short 5-minute answer, but what do you think is the future trend in financial services consolidation that you see?
I think it's benefit of speaking.
So basically, your pipeline. That's what you want to know.
I'm not going to share the pipeline. That's where I get the money from. But benefit of speaking the last, I think, look, the Rajiv also talked about it and Mr. Rao also talked about it. But we also firmly believe that larger is the game of the name. So in the banking system, you have to be large. It is a pity that State Bank of India, and sorry Prashant, you obviously know the numbers, but SBI is the only bank which is there in top 50 banks in the world, which is about 75 odd lakh crore kind of a balance sheet size. It's a pity for a country like India, as we talked about earlier. In the scheme of things, we have to be large. We definitely see a consolidation. The larger banks will also add. Plus, there is a middle and the lower level of the banks, which I think is just middling around. I think there will be some consolidation. Having said that, this I have been saying for last 15 years. It's very difficult to do it, but I hope that in the next 5 years, we'll see some banking consolidation. And the reason for this is that their customers will demand for it. And I'm again going back to the same theme, because this is how we actually keep saying and repeating ourselves, is that we have to be bold. Unless we change with the changing times, the world will move ahead, right? The banks who are not going to keep pace with the desires of their own clients will fall behind. The companies are getting ambitious. To that extent, they will look forward to their banks to essentially support them in their overall ambitions. The bank's balance sheet must need to support their ambitions of going cross-border, right? And which can only be done by the large bank. So that is one reason. I also think so that, look, players such as ANBD will continue coming out here. There are multiple other European banks who are looking at India with lot of interest, but because of variety of reasons, as we have discussed in the past, that because of the voting regulation cap, because of that 10%, 20% kind of a limits, they are not able to come in. But I sincerely hope in the next 5 years, for the benefit of our own country, that we actually look at these things holistically again, and then there are global banks who are essentially willing to come in, and there are opportunities available in the country as well. And the third, which I also feel, is that, look, we talked about in earlier NBFC markets as well. There are lots of high quality NBFCs which have actually developed a niche in their segments, right? There are very high quality companies for affordable housing, MSME, or say vehicle finance, or say an education finance. I think banks have shied away so far in acquiring any of those capabilities, but in my view, as the banking system will have their own currency, and overall the market will evolve, I think the banks will be looking to acquire some NBFCs as well. So 3 things: banking consolidation at some level, players such as ENBD, the global banks will continue to come in there, and we will expect to see some NBFC consolidation as well.
Yeah, in fact, I think that if conglomerates are allowed banks, you will see some of the large NBFC conglomerates strengthen the banking sector.
Yeah.
Which,
And I think one point which I'd like to add, you sort of follow the clients, follow the customers. In fact, that is one of our core strategies, follow the clients. So where we see from UAE or from GCC, where the capital flows are going, you need to follow those as banks. And if you are able to serve your home clients and traverse the trade links very well, the banks grows, those economies grows.
so Neeraj, that's exactly my question to you. We all spoke about two people here who are trying to capture the India-Japan corridor, mostly. But for you, Middle East actually has now become an increasingly high source of capital for Indian corporates. And I think global flows are moving from financial centers in Europe, especially London, to actually the Middle East, especially Dubai in particular. So how do you end up playing this India-Middle East catalyst as far as transactions are concerned, as far as banking is concerned? Follow your customer is basically.
So I think, traditionally people have looked at the Middle East more as a remittance corridor and maybe a little bit of a trade corridor. But I think that's changing very fast, right? As you mentioned, Dubai is becoming one of the wealth, magnets around the world. We've got, I think 12 of the largest 20 hedge funds are now based in UAE. And out of those 12, 5 funds have their largest trading teams sitting in Dubai. Not in London, not in New York, not in Hong Kong, but in Dubai, right? So I think the trend will move away from just the traditional way you look at it is to more from capital flows, talking about private credit, big time wealth management, and you will also see a lot more, banks or financial institutions not only just being, transactors in between or enabling transactions, but being the orchestrators to bring what, Anshul was talking about, is to bring the pools of capital to the entrepreneurs or to the businesses around. Now, look at it this way. India is a $4 trillion plus economy, growing at 7%. The amount of investment which is needed, and also look at the consumption economy in India which is growing, right? So we keep on talking about India, 1.4 billion people. But I read it somewhere or someone told me, and I always was saying, he said you have to look at India as not one homogeneous market, but basically 4 different sets. And globally, companies have to decide as they come to India as to what they want to do, right? You have a Qatar or a Belgium and on top, you have a much larger, you can say $100 million economy, 100 million people economy, where the per capita income is around $30,000-$40,000. Then you've got a big USA, 350 million people. And then you've got a large Africa. And this Africa will someday move into the next level, and the US will move into the Qatar or the Monaco level, right? So you have to kind of think from that perspective, and you have to, so keeping that in mind, I think UAE sits, the Middle East sits at that hub of that transition, that global, right? So that capital flows from the West coming down or from the India going to Middle East, Central America, Central Asia, Africa, and even back to Europe. And I think geographically we sit at such a neat point that it's going to become more and more omnipresent as transactions flow, as capital flows, as deals flow.
I mean, even if Anshul's 100,000 moves to a million people, you're there. Yeah. Your flows are multiple of what you can think of.
Yeah.
So the last question, I think I'll come to Prashant Kumar again, around the domestic regulations which has opened up. So we've seen that in the last 1 year, the governor, or the RBI rather, has opened up regulations significantly. It says you can have multiple entities. It's kind of blurred the lines between the banks and NBFCs as far as most things, except deposit taking, of course, is concerned. It's opened up things like M&A financing, which frankly is a huge opportunity India has lost because every private equity leverages. How do you think, are Indian banks ready to do more different kind of credit? Because my worry again was, from the fact that if $10 billion of capital comes in, and if much of it is employed to doing the same thing that we're doing, we're going to end up creating bubbles. So how do you think other avenues, especially things like M&A financing or stealing the cherry from under the private credit guys, how will some of this banks will enable themselves to do?
No, I think last 1 year, regulator is responding to, I think, the demands and needs of Indian banks very, very fast. I think this demand actually was put forward by the Indian banks that why we are not allowed to fund the acquisitions, okay, which has been, like draft guidelines are already there, but definitely regulator would always be very cautious. So there are certain guardrails in the draft guidelines, like a bank is not allowed to invest more than 10% of their tier 1 capital. For this particular activity, and I think we understand that to begin with, banks need to build the capabilities to assess these kind of transactions and maybe put the small amount and see how it would. But the another regulation is also talking about that it is allowed only for the Indian listed company. I think that is the feedback which banking industry has given back to regulator, that this is being seen as a somewhat restrictive guidelines. Because if it is can be done only for the listed Indian companies, then I think the whole landscape which is available would be restricted to the Indian banks. So I think let's see when the final guidelines would come and how the regulator would respond. But at least the beginning has been made. Beginning has been made for the acquisition financing, beginning has been made in terms of even the capital market, in terms of like taking a loan against the shares and other things. So I think over a very, very long period of time, the regulator has responded, and I think last to last, the policy, I think almost 34 changes. 34 changes they came out. So I think the best part is, during our interaction with the regulator at the periodic interval, I think they are very receptive. It's always like we as an individual would also always aspire like regulator should allow this, that. But I think regulator being responsible for the entire the integrity of the financial system, which is so critical for what we are talking about. Today we are talking about India is growing. There is a confidence in India, and that's why we are able to attract the capital. I think the one thing is in terms of the soundness, robustness, and the confidence in the Indian economy. I think this is something which regulator always like to maintain, and I think that is by and large is good for everyone.
Thank you, sir. So in conclusion, before I open up for questions, I just want to make a few remarks. I think we heard that there is scale which has been highly pursued. There is capital flows which come into Indian confidence. There is a high level of surplus Indian money that will get invested outside, and banks as well as investment banks end up playing a larger role. But more importantly, the regulator has done a few good things. One is, I think the emphasis on regulation is reducing over time. And of course, the emphasis on supervision is going up significantly. If you see the amount of onus on the boards today is very high and should be. Especially I was glad to see the related party transaction bit, where they've moved away from restrictive covenants to more board-controlled supervision-related covenants. And this supervision, I don't mean regulatory supervision, I mean governance. So actually a lot of us have moved towards that. Of course, as Mr. Rajeshwar Rao said, we need to change the 1940s regulation around 26% cap and the 1940s regulation around not allowing promoters to own companies, because if you look at empirical data, and people like Anshul can clear it, you look at a Bajaj or you look at a Mahindra or you look at a Tata's, I don't think any of them have really used their lending for any connected entities. Yeah. They have built enterprise of their own and they have proven that they can do better than what most banks can do. So technically, there is a myth in our minds which we need to correct to a great extent. On the last part, I would say that while banks are controlled excessively on the back of the fact that they take public money, and I think Mr. Rajeshwar Rao also enumerated to that that public money is actually leaking into non-public areas, especially when you take capital market exposures now, you will actually find that public money will go towards funding stock markets. And hence, the risk is more empirical. So just controlling banks on public deposits, the way the restrictiveness that they do, I think they would they would do better if they control the liability side better. I mean, imagine if 300 lakh crores is going to hit the mutual fund industry. There's absolutely no control in terms of depositor protection. Isn't that public money? Of course it is. But because it is not sitting in an asset manager's book, it is not controlled as aggressively. So there is room for a revamp in regulation, which obviously is not the topic of today. But between regulation and consolidation, I think the government has enabled a lot, and we hope for them to do more. We have a minute or two for questions. Please. Mic, please.
Hi. So Abizer, on the connected issue which you just concluded, I do a lot of financing plus enforcement advisory as well. So during the boom cycles, generally there are boom cycles for M&A also. How do you balance it out in terms of the mitigation, risk mitigation strategies and also diligence aspects? Because during the boom cycles, there's no end. You can just fund. The funding can increase. As and when these regulations come into the final stages also, are there any checklists or safeguards? I mean, I'm just told one option listed one. Any 2-3 pointed checklist which should be kept in mind, because a lot of lendings happen, but there's limited diligence. So
yeah, I am fundamentally against checklists, but yeah, people can answer. So they're saying, what are the few things that you should safeguard on the lending side?
No, I think the most important part, and which we have seen over a period of time, if you can take care of the concentration risk. I think on the lending, sometimes we talk about a particular sector, other thing, underwriting and other thing, but at least because Yes Bank has gone through a very, very difficult cycle, I think whether as a bank or even a non-bank, concentration is something which needs to be very, very closely monitored. And I think if we can do that, because the cycles would come and go, and cycle will come in the different kind of asset classes. So if it is widely distributed, your lending side, then I think it would be able to take care of any adverse credit cycle which may happen in any particular thing.
I think just to add on to that point, I think the other thing from a safeguard perspective which the regulator or the government needs to look at, when you see this kind of transition happening from bank deposits going into stock markets, into derivatives, into private credit, the thing is that history tells you that whenever crises happen, it's the retail investor who suffers the most. The institutional investors do get away or have better checks and balances to see the amber lights coming or the red lights coming and position themselves accordingly. So one of the key aspects which the regulators or the government will have to look at as this societal transformation happens from bank savings onto capital markets and other fancy instruments, there are proper safeguards put in place out there. And some sort of, I would say, maybe a higher regulation on that side, or making sure that the retail investors are well educated and know the risks of moving away from, your debt-based savings instruments to more equity-based savings instruments.
Right. This way. All right. So I'm Neeraj Gupta from Tevala Holdings. We are in venture capital, and we do work with HNIs, investors. So I'm curious about for a long-term capital perspective, which banking model look most investable over the next decade?
In banking model in what?
Yes.
Banking model from what perspective? Like traditional banking model?
Traditional banking, retails and all. So
look, ultimately all banking models need to survive, right? You cannot say that retail banking will thrive and corporate banking will go away institutional banking will not be there. I think everything has to go hand in hand as an economy evolves, and it depends upon which direction the economy evolves. You will see phases which will go through. But I think the banks which will do well will be the banks who will have a much diversified set of businesses, and will also probably, as you see, that there's more happening towards the wealth side, there's more happening towards, like Abizer talked about that, you have the likes of ICICI and Kotak and all, which are going through the value chain, and they want to be present at every value chain. I think banks who are able to become universal banks from that perspective, offer asset management, offer securities, offer wealth management, and have all those sort of products, will have much stronger balance sheets and much stronger growth potential.
And given that I heard that you are a venture capital provider, then maybe essentially you're looking for an early stage investment. So look for platforms which are using technology in a big way. Because as you would have heard the earlier panels as well, that look, if a new bank is being set up or something like that sort of, I don't think so they'll be able to challenge the might of ICICI or a Yes or an Axis, right? So to that extent, see that look what they are doing differently, what kind of an AI capabilities and the tech capabilities they have, so that they can manage their OPEX in a much, much leaner fashion and make some right to win for that. So it is not easy to make money in the bank at a smaller level. You have been hearing this for the last 3 hours. We have been saying is that the larger is the name of the game, right? So how do you make money at the smaller level? So tech is the only intervention which can potentially tilt their scales to some extent.
My question is how Indian banks would go global and truly cross-border in a big way, rather than Indian expats, a truly global Indian bank of large size, many banks. So what is the way and how long it will take?
Whether we really think like we don't have a adequate opportunity in India, and there is a need to go overseas. I think we have seen over a period of time, the banks, because especially the public sector banks, who are having a large presence in the overseas geographies, over a period of time they have also rationalized that kind of thing. Because making money outside is not very easy because of the regulations and a lot of other obligations. But I think in India we have enough opportunities to grow and make money.
Yeah, absolutely.
So I think the way it will depend is, again, as he was talking about Sun Pharma going out, you've seen Tata Group made forays in the Middle East, in Europe they bought. As Indian corporates grow big enough to start going outside and external and start becoming Indian MNCs, which then require capital, which then require debt, you will automatically find 1 or 2 banks making those forays and going forward, right? So it's usually banks follow the clients and the growth opportunity. I think what Prashant talked about out here was banks from countries where the growth opportunities within those countries seem to be, I wouldn't say limited, but you've kind of more saturated and mature markets. Then you say that I need to continue growing, so let me go to growth-oriented market, right? And that's why. So it depends upon where you are in your growth cycle. Right now, India itself is growing. The banks themselves are probably finding it challenging to kind of fund the growth in India. So why would they want to take a risk of looking outside?
Though I see one thing, non-banking though, but I actually do see an Indian wealth manager buying something overseas to attract money into India.
No, absolutely. Indian banks, I don't need to think that, look, they need to go overseas, because as Neeraj mentioned, that a lot of global banks are coming to India because their own home markets are getting saturated. In fact, they are coming to India in the search of growth. Why will I go out? Indian banks will certainly try to build some dollar balance sheets to take care of the global needs of the corporates, right? If I'm going and acquiring something, so I need a global balance sheet. But it is not, don't expect an ICICI or an SBI branch in the US on the retail street. I don't expect that happening in the near future.
Right. With that, thank you, gentlemen, for the session. Thank you, everyone. Thank you.
Thank you. Thank you so much, Speaker, for informative discussion. Round of applause for our speaker once again. Now I invite Mr. Khosla to please present the mementos to our speakers as a token of appreciation. Requesting for a one group photo. I request Mr. Khosla to please stay back and please deliver the vote of thanks. Thank you.
So thanks a lot, Abizer and our panelists for this session. We had a wonderful, 3-hour session on the future of banking. I would like to thank Sri Rajeshwar Rao, who had specially flown down from Hyderabad for this. He's left early, but sincere thanks to him. Thanks to Lata Venkatesh, who came in. Our first panel also, as well as our President Rajiv Anand. Thank you to our sponsors, without whom this was not possible, both CRIF as well as SBI, for making this happen. And to all you wonderful people who stayed here for these exciting sessions. Hope this was informative for y'all. If you're not a member of the Bombay Chamber, please become a member, as there are a lot of such activities which keep on happening. We have a packed lineup this quarter with the budget on the first. We plan to do a major webinar on these, both from the economic side as well as from the income tax perspective, followed by a big shipbuilding conclave and others as well. So thank you once again for being here, and have a wonderful evening. Thank you.